Looking for the best opportunities in Perth property? Get the local area expertise you need from Momentum Wealth, WA's trusted property investment consultants. Market insights, advice and representation from award-winning buyers agents and REWA Hall of Fame inductees. Visit Momentum Wealth's website at momentumwealth.com.au to organise your obligation-free consultation today.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
G'day everyone, how you going? Welcome to the Smart Property Investment Show as we get set for Xmas, Christmas, the festive season. Everyone's pumped, excited, daunted, some people I know. I guess Paul Glossop in the studio with me. How are you?
I'm excited for a little bit of time off.
Really? I thought property buyers agents never slept.
Well, we do sleep, put it that way, but we do buy property typically every day of the year. But it's not just me that oils the machine.
So what is the saying, what is it, old soldiers never die, they just fade away? What happens to buyers agents?
I truly think that,
once you're a buyer's agent, always a buyer's agent.
I truly think that once you're, not necessarily a buyer's agent, but once you're in property, I don't think it'll leave you. I think it becomes that way. And you'll see there's generations of people who've invested, developed and bought and sold property who they live and breathe it. I just saw, digressing a bit, I was thinking about someone who was actually escaped my name. What's his name? Gonski, David Gonski.
Yes.
I don't know if you would have seen that. Just made a not a small fortune, a large fortune in a Bunnings property that he bought in a syndicate only 3 to 4 years ago. Logistics spot on a corner block in Alexandria in Sydney. Recently sold it for $77 million. Was bought sub 25 with some rezoning.
There you go.
A little bit of money made there, but it goes to show that these people have been involved in this for literally decades and decades. And I don't think he needs the money anymore, but there was some big money made.
Well, he can give some more to education. He's
famous
for
the philanthropic works that he can continue to do.
This is true, but it goes to show, I think property it's interesting because a lot of careers you only have a particular period of time to be exceptional at it. And by that I talk about football.
Yep.
You might have 5 years of making money before you snap a leg and you're out of the game, right? But property is ageless. And that's a good thing about property as a career. Career being creating your own wealth.
Yeah. And if anything, there's probably an argument to say that the longer you're doing it full time, the better you get at it.
It's snowballing. Every time you're learning, you expand your network, you get to know new people. Talking about Gonski in a syndicate, whoever that syndicate, probably a bunch of blokes he's known for years. And they just going, hey, everyone pony up a few $1,000,000 here, we'll buy this, sell it, whatever. So you get quite sophisticated in your property investing. And that is the journey as a property investor in that. Most of us start off buying less than glamorous houses out in the western suburbs of Sydney, and now you're buying fancy joints all over town, right?
Yeah. And
You've given up the western suburbs.
No, definitely.
And I'm going to ask you about that today, where to be investing.
That's absolutely fine because I can tell you a couple of places in the West that I've recently worked on. So, absolutely happy to go through the full circle almost.
Yeah. So, anyway, we're sort of a bit off topic. So, Paul Glossop from Pure Property Investment, good friend of Smart Property Investment, one of the many buyers agents I lean on to make sure that I'm getting the right information so I'm more informed so you all know what's going on. Interesting market right now, Paul, in that here we are, literally Christmas just around the corner. Australia's done it tough as a nation as a result of COVID-19, but not as tough as most other countries.
Correct.
What was dire predictions in March, April, May of this year with a number of large banks calling 20, 30+% reduction in property values. Here we are just before Christmas. Everyone's talking about a market that is booming. There's a number of different reasons for that. One is money's super cheap. And number two, the government's done a pretty reasonable job shoring up our economy with a fair bit of stimulus to keep Australians in jobs. The predictions around huge unemployment has now come back to where we are, about 6 to 7%.
Yep.
70% of people who were canned when COVID hit are back in jobs.
Yep.
It's a good economic story. And only a couple of days ago, we had the Treasurer on the television saying Australia is out of a recession.
Quickest recession.
What happened? Where did it go? Did some magic fairy just come and sprinkle some dust on it and it's gone?
It's amazing, isn't it? It truly is amazing is that what sentiment can do as well from a property perspective. But I'm not going to go out and say that I'm Nostradamus per se at all, but I did put some...
You know that guy, Nostradamus, normally predicted bad things, right?
He did.
Not good things.
Well, either way, he was predicting.
Do you want to be the property Nostradamus? Is that you?
No, well, not if I'm predicting bad bad things. I think that's Harry Dent. He's already got that mantle.
Oh, he is, right.
Yeah.
40%, Mr. 40%.
Mr. 40%. I wish it was, if you could figure out how to make Mr. 40% upwards, then he'd probably make a lot more money. That aside, what I was posting, and I guess what I was alluding to there, is that we put out some really, really detailed data back in April. And I think you and I actually did a webcast on it, funnily enough. And in that time, what we did at Pure Property, we went back
when you were in lockdown, I remember.
Exactly.
Yeah.
And I filmed this with you, and we did literally did this via a webcast. And at that time, I literally went through all the specifics over the last 4 major downturns that we've been through, both in Australia and as a global economy. And some of the major things were, if we went through the 70s recession, the 80s recession, the 90s recession, the .com/9/11, as well as the GFC, what we saw was different impacts to the economy, all of which obviously saw a reversal in our economic growth, and technically not necessarily the GFC, but every other time pretty close to it at the .com boom, but that definitely was a recession overseas. And then looked at what happened economically and then what happened to the property market the subsequent 5 years. And lo and behold, every single impact to the economy in Australia and globally resulted in, not necessarily, I'm not just going to say it resulted in property growth, because that's a byproduct of what actually had to happen, but you saw economic stimulus, you saw tax changes, you saw changes to lending policy, you saw money get cheaper, and all those things typically happened very, very quickly and in a successive period. And what ends up happening is the intention of that is we need to stimulate the economy. And in Australia in particular, they know that stimulating the housing market stimulates the economy. Those concessions were put in place immediately. And within 2 months, we saw the best conditions we could possibly see. There's a few things I also highlighted back then to say, if we were to see some amazing things even change that could really supercharge the market, A, stamp duty, and B, changes to lending restrictions via APRA and ASIC would also put a supercharger up the rear end of a property market.
A supercharger actually goes on top of an engine.
Apologies.
Doesn't go into the back of a car.
I definitely am not a car person.
Right.
My Mazda 3 downstairs will be a testament to the fact that I have absolutely no idea about and my air conditioning hasn't worked for a year and a half.
Bore it out.
Bore it out, 40 thou, 9-inch rear diff. I don't know what I'm talking. There'd be some car enthusiasts that would just be cringing at listening to this. Right,
there's a lot of car enthusiasts who are also property investors.
Very good ones too.
But what you're talking about there is it's tough, right? Because a lot of people, what you spoke about there, they're going, yeah, I get that, right? A lot of other people are going to go, what do they just talk about there?
Yeah.
And you're talking about macro and microeconomic fiscal policy all wrapped up into one, right?
Yep.
And Australia is in a particular spot in the world, and we have trading partners, we have geostrategic, geopolitical alliances that support the economic growth. Australia, Paul, before COVID-19, I think it's got the 12th biggest GDP in the world.
Yep.
13th is Russia, right?
Yep.
And we've got 25 million people here. So, Australia has spent 70 years after the Second World War concentrating on economic prosperity and growth. And it's been a great story that's held as one of the exemplars globally. Australia's spot in the world is starting to change a bit. Maybe not, now it's a globalized economy. Look what happens with COVID-19. It impacts us. But, I like to think we're a bit like an elastic band. Yes, it was tough for a while there for Australia, but some bright people did some right things and we've snapped back into where we need to be.
Yep.
And therefore you're seeing these inherent dynamics which underpin wealth creation for Australians driven by property. So that's the market we're in right now. So we're obviously connected in with all bits of data and all the different commentators saying what they say. You speak yourself on it. I don't really lend an opinion on it. My job's really just to curate what people that know what they're talk about, yourself included, right? There's so much data out there though, so you can find and you can prove a trend by finding some data to support it. Any given
confirmation
time, right?
bias.
Confirmation bias is what it is. You need to be careful with that. But so data can tell some stories. There's been a recent piece of data coming out from SQM, which is a good data house. Louis Christopher, a very smart dude who I'm sure he'd be happy me calling him a dude.
Unequivocally.
He gets it right. Sometimes his views are polarizing and he gets beaten up by certain segments of the property and sort of the wider economic commentary community. But by and large, he gets it right and he gets some good stuff coming out. Now, he's just put out his boom and bust report recently, right? So this just lends itself to this narrative of what is driving and shaping change, positive change in property in Australia. Now, what's he saying as part of this report?
Yeah, and that report breaks down typically both as a nation and then also our major capitals. And then effectively what also is put into that report typically is a base case and then working through a couple of different iterations of what if this happened, what if that happened, and what would be the overall position. So if we talk about base case, and base case is essentially what that means is we go through exactly where we are now, lockdown laws lifting, we get a vaccine that's rolled out sometime by the end of 2021. Our borders remain open interstate with the hard border of WA being lifted, and essentially the economic stimulus that's being rolled out as far as JobKeeper, JobSeeker, everything that's already been announced stays consistent. So that's base case, and not international borders opening for next year. Take that into consideration. So we're not talking about a huge additional flood of tourists, overseas travellers, skilled migrants, etc. Not yet. And also, this doesn't talk about stamp duty, and it doesn't talk about necessarily the changes to APRA's lending policies, the responsible lending laws being repealed as of March 2021. So there's a few things there that I mentioned that I think are worth considering as well. That will most likely impact the market on a positive note. But if I look at that, some of the really key highlight factors here are Perth is number one on the list of proposed capital growth, which puts a smile on my face because I've got a lot of clients who we've bought property in Perth for since mid-2019, but also very, very active in that market at the moment. When I say Perth in general, I'm not necessarily talking about the attached market. We're talking about detached houses, 600 to 900 square metre. And actually quite a lot of those markets, we're talking sort of that entry level to the middle ring. So we're talking as low as 220 to 270 price points right through to probably as high as 550, 600K price points. That's a market we expect anywhere between 9 and 12% capital growth in 2021, which is an absolute standout figure for Perth because it peak to trough, it was 30% off its peak of 2014.
It was lackluster for quite some time.
Absolutely.
So the only way for Perth to go was north.
Yeah.
It couldn't go much further back from its peaks back in the day. And
but
I know a lot of people blew their dough out there, but, you know, if you've been able to hold on in that market, at least you've got a head start for, markets moving. So the boom and bust report is by and large quite positive for property.
It's as positive as I've seen it since reviewing this report for the time it's been issued. And that's a long time. And it's not just necessarily, and typically when you review the boom and bust reports, and it's also, it probably affirms data that was released by CoreLogic's monthly indices report as of yesterday for November. November actually saw the first month since 2002. The first month where you see the indices report, which breaks down each of the major capital cities as well as each of the major regional centres across the entire country, showed a positive number. So every single city.
Let's get into that. We'll just go to a break beforehand and we'll keep digging down the data. Back in a moment.
Whether you're an avid property investor or about to buy your first property, why do it alone when you could partner with Australia's best buyer's agent? Director of Pure Property Investment, Property Investment Professionals of Australia board member and REB Buyer's Agent of the Year, Paul Glossop, can take your portfolio to the next level. Get in touch today to discuss your investment goals. Get one-on-one insight from Paul Glossop. And for the first 100 people, this service is completely free. Head to purepropertyinvestment.com today to schedule your consult with Paul Glossop directly.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Paul Glossop. He is the CEO of Pure Property Investment, a buyer's agency, property strategist company.
Both, yeah.
So I saw you at a barbecue and I went, oh, g'day, I'm Phil. I do podcasts for a living and I'm really, really bad at them. What would you say? And I went, what do you do, Paul?
I'd be saying, firstly, Phil, if you're bad at it, why are you doing it?
Because when you get really good at something, what is that old advert?
I know exactly what you're talking about. I'll get it wrong.
Was it some carpet company, wasn't it?
You're losing everyone here. This is why you're bad at podcasting.
This is why I'm bad at podcasts, and my ability to recall information is crap. Hence the reason why I lean on data, right?
Yeah, please do.
You get very good at segues, right? Now, what do you do?
I'm a buyer's agent.
You're a buyer's agent.
I'll put it really simply to people, a buyer's agent.
And do people know what that is?
No chance. No. You'll get, but to be fair, it is changing. And I think for changing for the good. But the reality is hopefully, and I think there's a lot of good work that you've been a board member of Pippa in the past. I'm still an active board member of Pippa. And I think the awareness of both what a buyer's agent does and what it should do, as opposed to you're involved in some development company who sells off the plan to people. It's more along the lines of we set strategies for people to then achieve financial success through property.
Okay.
It's not complicated.
So if that's the case, then I'm going, okay, is there, next question, where do I buy?
Yeah.
Okay.
Yeah.
And I'm sure you don't tell them, but I'm going to get it out of you today. We're going to get some hard facts where you should buy. So the purpose of this podcast, Paul, this week is just to get a bit of an understanding of the current market and the current economic climate and how that's shaping changes and what is positive changes in the property market. So it's pretty hot out there right now.
Super hot.
Lots going on.
As hot as it's been in 5 years.
It is. So, but I was talking about my inability to recall information, so therefore I lean on data quite a lot. Now, what a lot of property investors don't understand or appreciate is that the data you're looking at today is pretty old. So there's this data deficit. So it takes some time for data to trickle through. So you got to be careful when you're basing your decision making on the data sets that you have because it's not immediate. So, the question, Paul, is what markets are already booming that you haven't yet seen them booming yet in the data that you're able to get right now? So we're talking about beforehand the boom or bust report,
indices report,
indices from RP data. They do that hedonistic report as well.
The hedonic report, yep.
Hedonic, what was hedonistic? I think that's something very different, isn't it? Anyway, moving right along.
Please don't cut that out.
Hence the reason why I'm not very good at podcasts, right? But there's all these reports, like all the different data houses. And you know who I'm thinking about.
I'm not going to say it.
There's all these different data houses provide different information. So it can be confusing.
Yep.
And I know a lot of investors make the mistake of basing all decision making on data they're picking up. We're on smartpropertyinvestment.com. It's got really good data as well. Go check it out. So what markets then? Where's the secret markets right now where you're not yet seeing in the numbers that these markets are firing on all cylinders? Can you tell us where?
I'll list 3 markets, and this is going to be to the detriment of what we're buying because I can tell you actively we're buying in some of these markets right now, and this is only going to make it worse. And I would say that because the fact that there is record low supply and anything that's hitting the market, when I say hitting the market is advertised full campaign, is gone to multi-offer within a week. And when I say multi-offer, it's gone way above what they would be putting as a proposal. So if I was to list probably 3 markets that I would suggest that, and when I preface this information by saying the data that you typically see of where the actual growth or the value of the average house price in these markets is typically about 2 months prior. So we're talking a lag from somewhere in October to where we are now, early December. Markets in Brisbane, freestanding houses probably between around about as low as 250 if you can find them, good luck. But as far as 250 to 700K markets, and I would say specifically parts of Moreton Bay and also parts of Wynnum West, Manly up towards the Bayside, and they're probably more of that premium higher end. Freestanding houses, non-main roads, if you can find rezoned assets, absolutely. Walking distance to train, walking distance to typically either university, hospital, or probably within 2Ks of 2 major school catchments. You are finding those markets right now. I would suggest by March, they will show that they've already seen 5% growth in Q4 of 2020. So they literally, we've got a property that I was looking at, and this is anecdotally, I probably were looking at last night for a client. One of my buyer's agents is on a plane to look at over 30 properties in the next 2 days, made a phone call to this agent, say, can I see this property today?
Gone.
That property is under contract for $500,000. We literally bought a property in that same street 2 months ago for $445,000. Both of them 422s on a touch over 500 square meters, single story brick, owner occupied.
So like for like?
Like for like. Literally, there's $50,000 difference in each of those 2 properties.
$50,000 of 450 is a lot more.
It's a lot more than 5%.
5%.
And I say conservatively 5%, and that is on the ground truth of what's happening in that market. And I expect that we're in the very early stages of some very, very strong times. And that's not just sales prices. We're seeing vacancy rates sub 1%. Anything that's hitting the rental market is gone under multiple applications and people putting in higher offers to just secure the property in the first place. So good time for investors who are also got access or already own assets in those markets, because they're going to be in a position where their rents will increase because supply is effectively not being created. These are backfill areas now.
So that's a good point, because I was going to ask you, why is this the case? And I'm happy. And if you've been shooting a Smart Property Investment, you know that we have the Smart Property Investment portfolio. We have a lot of assets in Brisbane. Been waiting, like most investors, for a number of years for Brisbane to do its thing.
Buy your lobster this Christmas, Phil. You've been waiting.
Mate, I'm going to crack open a tin of Spam. I might even heat it up and I'll sit there and I'll...
A sprinkling of paprika.
Maybe. A little oregano on it. Live the dream. But everyone's been waiting for Brisbane, right? Everyone's been waiting for Brisbane. So is this Brisbane's time to shine? And what you just pointed out there is the dynamics of what you're seeing on the ground right now. That's before the data is showing it. Point number 1. Point number 2, why is this the case? Like, is it purely a supply and demand equation, or is it complicated by the fact that, well, supported by the fact that money is so bloody cheap and Aussies still have jobs and Aussies are thinking about the future? Because you're not going to have a lot of, international people buying that stuff unless they're return expats, right? They're not buying that stock anyway. They're buying owner-occupied type stuff, right? Like, what is driving this?
Well, the reality is it actually is majority owner-occs in that market now. And that's the big difference, is that Brisbane, as a classic example, when people were touting it should have boomed probably 14, 15, 16, you had that coinciding with their boom of the supply coming of their off-the-plan stuff, which was, unfortunately for Brisbane, was poor timing. It was probably poorly controlled from a city planning and town planning perspective. You just had too much supply in new stock. And there's still areas in Brisbane which I just would simply not touch. I'm not going to necessarily mention them not to get anyone offside here, but there's areas and property types where have still got a lot of available land, and there's still that 3 to 5, 6 year building horizon.
So you're talking about fringe type stuff, right?
Fringe, as well as you're talking between Gold Coast and Brisbane in that stretch, you've got a lot that's going on in there, and that won't stop. Now, that's a market that will still see demand, but as far as that ongoing consistent capital growth, I don't think that's going to be anywhere near the same level as other infill markets. But what's driving it is similar things that you've just mentioned. You've got the supply is now dried up as far as that glut of too much supply. That was starting to dry up about 18 months ago. The actual approvals for new supply in Brisbane is very low. So they're building, especially in the detached housing market, they're building at record low levels now over the last decade. So you're going to see, and that's usually about a 2-year lag between approvals and construction and completion. So you're going to see that that's not going to change anytime soon. And that's also obviously affecting the rental vacancy and then rental value market. So you've got investors, owner-occupiers. Queensland's come out of this whole market, as well as where the economy stands now for the next 5-10 years, as they've got a lot of money being spent both from the Sunshine Coast down to Brisbane and further down the Gold Coast for infrastructure, for jobs creation, and also you've got the resources sector lighting up now. So you've got that in addition to what was happening. It's also now, you're actually starting to see places like Melbourne and Sydney starting to see tree changes, sea changes, thinking, I will get value for money and I don't want to be involved in Melbourne in particular due to what's happening in the second wave of lockdown as well. So there's quite a number of things that have happened very recently, and that's really, I think, is very early doors.
So what's going to change this current market dynamic with there being more buyers than sellers? What's going to need to happen for sellers to start wanting to put their properties up for sale? Is that highlighting the spike in prices and people going, hey, hang on a second, now it's time to actually do something? But if you're buying and selling the same market, you're not ahead of the game.
And this is the really interesting thing that I don't think we've been in this predicament. And I'll go to the next reason why that is that I don't think in our existence we haven't seen this issue yet. And the reason being is that we haven't even talked about what's going to happen with stamp duty. Now, New South Wales, obviously, it's in discussion. Victoria have just announced that they've got different concessions depending on whether it's going to be brand new or secondhand, and they've got 25% concessions and then 50% concessions. We've also got now Queensland, and you've got South Australia, you've got WA, Tasmania are all in discussions, and that's probably going to be something we see uniformly will be changing over the next 12 months. But if I'm an owner-occupier or an investor and I'm thinking I'm going to trade out of that property and then go buy that next property, the challenge that we're going to have, and from what's been put forward for New South Wales as an example, is that if you're going to sell a property that you've already paid 4%, potentially more stamp duty on, and then go buy a property which may not have stamp duty but will now have a flat-based land tax for the entirety of the time I own that property, which I don't have to pay because I've already paid stamp duty on this other property, what's incentivizing me to trade? And I think that's the challenge, which this stamp duty change is in one way interesting, but another way I think is not going to provide additional supply to certain markets. So what's going to change and what's going to incentivize people? I don't think there's going to be that much, because if I look at the market's growing and my rents are growing and the actual cost of money has decreased and the economy is doing fine, then my impetus to say we just need to get rid of that property gets less and less by the minute. I've got better cash flow, lower rates, more confidence, and ultimately more confidence in what's going to happen both in the market and my own net wealth.
So tactically then, as a property investor, and always look at how the best properties go about doing stuff, if you wanted to play that game, you'd be trading out of markets which are booming and then resetting that money in markets which are still to boom, probably in another state, or at least in a very different location to where you've pulled out of. That's how you make your money right now.
Absolutely.
And this is quite simple, but that's the secret.
It's a really good point, Phil. And I think that's probably one of the points which really people need to start thinking about is that we haven't even seen, and another thing we haven't seen affect the market yet is the repeal of the responsible lending laws as of March
We'll get
next
into
year.
that. I want to go to another break, but we'll leave that for a moment.
Definitely. But I guess the reason why that is going to be, in addition to all these other things, really where the ability for that to come and allow markets or people to really multiply their profits in today's markets is recycling in equity extraction as opposed to exiting and reusing that money. Because for me, the smart money right now is keep the property in the market, extract equity, reinvest, and try to use this cycle for what that's going to be good for.
And therefore, that comes down to cash flow, right? So you want to be trying to keep your assets, leverage the capital growth through drawing out that equity at very low rates.
Correct.
2 to 3%, even lower.
Yeah, and fix them if you're really unsure for 2 or 3 years if you really, really needed to.
Yeah, and then but deploy that money in different markets. So, but this is the point though, is that where are those other markets? And you're not seeing the data tell you where those markets are right now. And that's why you really need to know what you're doing. We'll go to another break. When we come back, we'll pick that chat up and try and give you a few more insights back in a moment.
Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Paul Glossop from Pure Property Investment. Now, we'll get into changes to responsible lending, Paul. But let's stay on that point before the break. You're talking about recycling your money, right? That's one way. So you can either recycle would be two things. You can sell a place and realise the capital value that you've had in growth and redeploy that money elsewhere, the redeployment strategy. Or you can recycle through refinancing, pull out enough so you can go and buy another place while you keep that asset and hopefully it still shows growth, right? So if you go down either of those pathways, you need to redeploy that capital growth, i.e. income, asset value, somewhere else, right? So the markets. So what markets now are actually firing that we're not yet seeing? You spoke about Brisbane, but where else? Like, should you be thinking regionally? Because a lot of people get caught up, and us included on Smart Property Investment Show, where we talk about capital markets, right? Where most of the data lives, right? You speak to any data house, it'll always be samples. Sydney, Brisbane, Melbourne, whatever. So talk to me about deploying your capital in smart places that no one knows about. How do you know it's the right place if the data isn't indicating it yet? How do you know it's the right place if there's no other investors in that market right now? How do you know it's the right place when you're blind to any of the ideas or any of the sort of dynamics going on in those markets? I guess that's what you do.
Yeah, that's exactly what we do. And I think there's probably twofold here. Is to a degree for anyone who's buying a property in a market that they're unsure of, but they're relying on us as buyers agents to say, here's the reasons why. That typically is a leap of faith of a 1 to 2 year buy before, as opposed to when the data, as much as I'm talking about data that hasn't dropped for 2 months, it's very rare that we see a market condition that we're seeing right now where we actually are already seeing growth and you've actually seen a distinct difference between when the data is going to hit and actual growth that's already happened. So I'm talking 2 months between sales data to when it actually is being deployed. I talked about Brisbane, where in some cases we've seen in the vicinity of 3 to 8% growth in the last 2 months in certain pockets, certain streets, certain property types. There's pockets in Perth that are doing exactly the same thing right now. And I'm talking that 250 to 500K. We're talking probably anywhere between 13 and 20Ks from the CBD within major airport links, new train line extensions, zoning changes of certain land, and properties that are now gone from potentially in their peak or in their worst times 4 to 6% vacancy rates now sub 0.5% vacancy rates, and you've got rapid rental growth, no supply, no additional property coming to market. That market right now probably supports that boom and bust report data we were talking about earlier. You're talking, and I would expect that we've already seen anywhere between 3 and 6% growth in the last 2 months where data doesn't support it. And we're going to see that 10, 12, and possibly even a bit more % capital growth in the next 12 months to the end of 2021.
Tell me this. How early do you need to be in a market to realise the full value of rapid capital growth? So if you pick something early, how early do you want to be in that market? Because a lot of people are going to go, I bought in Perth 6 years ago.
Yeah.
I was really, really smart. Right?
Not in Perth. They would have lost 30%.
But you know what I mean? So in terms of timing,
Yeah.
like this magical window, call it whatever you want, timing it before other buyers agents find it, other investors find it, whatever else, like to have your crystal ball and go, I choose location number X.
Yep.
How early do you want to be? A year, 2 years, 6 months, 3 months? Does it matter?
It's one of the most important questions. And the exact last comment you made, in my opinion, and the data will support it, that trying to time the market is fool's gold.
Yeah.
In short, what you can't control typically is the dynamics. You can't control what happened this year. And what's happened out of what's happened this year are things that we weren't predicting this time last year when we were buying in Perth, hypothetically. But what is happening right now is actually going to help that market in ways that we weren't predicting. So my point to that is this, is that what we know is what properties are renting for. What we know is what that property is going to cost to buy. What we know is what that property is going to cost to hold. So what I'm talking about there is we know cash flows. And we can pretty much with 99% confidence say, if you buy this property under these interest rate conditions, here's what it's going to cost you to hold. And you can say that as long as you can afford to hold that property for X amount of time, as well as switch it from interest only at this stage to P&I at this stage and pay it down over that 25 years, you're going to end up with this position. Now, you can factor in historical 30-year data of anywhere between 5 and 7% compounded growth. And if you've applied that, you can see that it's going to be a very, very big number in return. But I think if you're trying to say, I want to buy it and I want to recycle equity in 12 months and then I want to repeat or buy and sell and do the same thing, anyone who sets up their portfolios or investment strategies and tactics to support that type of ethos are always the ones who are going to get burnt and are going to chase the next fool's gold and the next fool's gold. Now, whether it's Bitcoin, whether it's hitting the share market early in the piece, whether it's buying up in Port Hedland at the boom times, they're the people who you typically see, unfortunately, repeat the same mistakes. And they'll have really big wins and they'll talk about them to every single person they can find, and they will have their head in the sand for 5 years.
Pokey player, right? They always tell you their wins, but you never know.
Never hear their losses.
Frittering money through.
And the point is that the best investors, and you know a lot of them, the same people that I know, you've got a large property portfolio which you've built up over time, and you talk about Brisbane that hasn't boomed yet. It hasn't stopped you and it hasn't made you lose sleep.
And this goes to the doesn't matter point, because if you're buying the assets and they hold their own and they're not costing you too much money, etc., then you're okay. And if you're not under stress, you can sort of weather that a little bit. And then because you're in the market, you can realise growth when it happens. The argument against that is that, well, Phil, you could have redeployed that money elsewhere in a market that did do something.
Yep.
Therefore, that wasn't a good investment. So I've been sitting on stuff in Brisbane that hasn't done much for 5 years, right?
Yep.
Like, that, missed opportunity cost somewhere else. So this is the dichotomy that you could perpetually balance, hence the reason why you need a diversified portfolio.
Exactly. And that's why also in that same vein is that you say, well, could you have bought one $2 million property in Kirribilli back in 2015? You could have. But would that have been the smartest investment? Well, look, time will tell. However, you've definitely either done really well or really bad, and N equals 1 there, but you've deployed that across 5, 6, 7, 8 different assets across, even if it's the same city. Cash flow's been better, but it also means that you have a choice to say, you know what, if I want to maybe get rid of one, to then go and invest in Hobart back in that time, which would have done far better, but you chose not to because you went into that market, you still had the choice. But if you go too heavy in, and you really are thinking, I just want to make sure that this is my one play, that's where I think a lot of people also make that mistake, is cash flow becomes much more critical and they actually are on the red line. Yeah,
well, you only realise your losses when you have to sell, right?
That's exactly it.
So if you can hold the line, and that's what the best investors have done over COVID-19, and the government has understood that, and so have the banks. The banks are highly invested in ensuring the inherent value of property prices in Australia. They don't want property going backwards, and because they don't want to be foreclosing people. Hence the reason why another piece of smart stimulus, if you want to call it, was, hey, look, if you can't afford your mortgage for 6 months, that's all right, mate. Like, you're going to have to pay it later on, but we'll help you out a little bit. Like, the banks didn't do that because they're kind.
No, absolutely no. And I mean, there was secret Treasury recordings and talks about the potential for the actual industry to be locked down. The real estate industry, they were even considering locking it down so they didn't see on-sell masses. So they didn't see this distressed sale. They were actually considering...
Yeah, they didn't need to. But the banks didn't want that.
No, of course not, because they're like, well, this is bad for business, and we know that our supers, everything else is leveraged into this, and if that tanks, then everyone else's sentiment tanks, and then everything stops. Consumer spending goes through the floor.
And look, banks are cool. They lend money and stuff, but I think a lot of people get confused about what banks are and who banks are, right? Like, banks lend money to make money that they pay to shareholders in dividends, right?
Yep.
Point number 1. Point number 2, banks need to be lending money, otherwise they don't make money. Point number 3, most Australians have some sort of superannuation, and whether it's a self-managed super fund or a retail fund or an industry fund, guess where your money goes? It goes into bank shares. Banks are inherent to the financial strength and the inherent strength of the Australian economy. fact. So when they talk about locking down property markets, they go, that's the worst case scenario. Hey, banks, little elbow on the ribs. Hey, look, just give people a bit of a break for a while. We can sort this out. It'll all be okay. And look where we are.
Yeah.
Look
and then
what's
they'll
happened.
probably come back and say, hey, no dramas, but just, those laws you gave us that stopped us from lending heaps of money. Can you look at maybe just changing those a little bit?
Well, maybe that's happened. Or not. What you're talking about, responsible lending. Let's have a chat about that. Maybe it's a quid pro quo, right? Like going, hey, we'll help you out. You help us out. The government knows that a lot of Australians' attitude towards their wealth is tied up in how they feel their property is going. And whether you're an owner-occupier or whatever, right? If you're an owner-occupier, you buy one house, great Australian dream, pay it off, heaps of equity, refinance every now and then.
Buy a boat.
Buy a new boat, get yourself a new Commodore. Can't get a Commodore anymore.
No.
We're generalising here, but if you feel wealthy in your property, you're going to go and buy stuff. You're going to go get yourself a flat screen TV. I don't know what you'd buy, caviar and oysters, right, most nights. But anyway, if you feel happy about your property and you're making money and your job is safe, you go and buy stuff. That helps everyone. So this is just how and why Australia is very different to the rest of the world in terms of our attitude towards property. Debt to income ratios. If you look at the World Bank will say, way out of kilter in Australia. We have our own dynamics here. Big country, little places you can think. I'm going to ask you, I'm going to help you make me feel wealthier, but responsible lending. So whether or not that happened, whether that was a trade-off going, hey, you give them a break and we'll make this thing go away.
We can speculate.
I'm not going to say that because I can't have an opinion on that because I don't know what I'm talking about.
Responsible journalism.
Responsiblejournalism.com. However, you can. If you think that's the case, well, that's, anyway.
Mate, this is your argument.
It's not my argument.
Yeah.
What is it? Responsible lending.
So,
why is it going away?
So effectively, we saw back at the end of the GFC that there were inherent issues with regards to, and this wasn't necessarily fully inherent within the Australian banking sector. It was much more applying to both what was happening in North America and what was happening in Europe. And obviously we saw the fallout in both those markets exponentially worse than what happened in Australia. And that's not necessarily just completely tied to the way we were lending money, the way we were assessing applicants, etc. However, I'm not going to go into the nitty-gritty of, I guess, what had changed and where it's going to be, but from 2009, basically all the way up to around about 2016, 17, there were certain screws that were tightened on every single person who was putting an application in to borrow money. Now, that was on serviceability. It was on what was deemed to be HEM, your cost of living, your expenses, all those aspects which come into how much money are we prepared to lend you, what category of a borrower are you, how good or how bad a risk are you for us to actually lend you money, your ability to pay it back, and essentially all those different facets. And it comes back down to the actual multiple of your gross income versus how much we're going to lend you. Hypothetically, you earn 100 grand a year as a household, 10 times income, we can lend you $1 million, dragging it all the way down to make it. And what the responsible lending laws effectively did over time was make it harder and harder and allowed people to borrow less and less, and also meant that the LVRs dropped down further and further and essentially just made borrowing harder. And to a degree, it did it for the right reasons, because you go back to 2014 as an example, in Sydney, at that time, the data suggested that at its peak, 64% of properties in 2014 in Sydney sold to investors. That's more than double.
That's your fault.
My fault.
Yeah. You and your mates.
I wasn't buying in Sydney back then, trust me. I bought in 2010, a heck of a lot back then, and so did you, and done really well out of it. But it goes back down to when do you buy, when do you not buy? And when you see that hysteria, and that is a bubble time, and that's a problem because there shouldn't be that simple and readily made amount of availability to credit. And to the point is it slowed down the market, and it slowed it right down to the point of 2017. It got to the peak, and then we also saw that the Royal Commission into the financial sector also at a crescendo then, and there was a whole bunch of findings which, there was turmoil for 6 months, and there was a lot of unsurety into what's going to happen in the mortgage market, etc. And as it's turned out, as we've just talked about, the banks won, mortgage brokers kind of got a second-hand compliment in the end. It took a lot to figure out that they weren't actually to blame. But long story short, we've now seen that APRA, ASIC and Treasury are now going to the point of, as of end of March 2021, those laws are being repealed incrementally. Yep. So what does that actually mean? In short, we expect it's going to mean that every single person who's going to try and borrow money from April 2021 onwards to probably get anywhere between 5 and 15% more access to credit. So if you earn 100 grand a year, at the moment, you can possibly borrow between, let's just say hypothetically, 700 grand, or let's say $1 million for a simple math's sake. By April next year, you're likely going to be able to borrow $1,050,000 to potentially $1,150,000, which what's that going to do? It's going to put more competition into every single property and ideally push up prices for those who are thinking that way.
And it interest rates are the lowest ever.
And that's not going to change. For the time being, you can still lock that same money in for 3-4 years at cheap
And there's
money.
a serious discussion around this, Paul, and that is this just going to create a bigger property bubble outside of this particular podcast? But we should really pick that up at some point. But, this goes to the inherent drivers of the Australian economy around property and attitude towards wealth. And Australians are within the top 3 wealthiest people in the world. What a great place to live.
Yeah.
And the fact that we actually have these conversations about, look, everyone in Australia is making money because we're property and property is great, whatever. That is unique in the world at the moment. Everyone else is like doing it tough, right? So, I think we all need to be very conscious about, how fortunate we are to live in a country that gets it right, and that's a great thing. But don't rest on your laurels. Like, get involved, get stuck in, roll your sleeves up, make a few bucks, invest in property because you can do it.
Absolutely.
You can do it.
And that is it. And there was ever a time probably in the last decade where you could say, hand on heart, if you're going to get involved. To be fair, I would have said do it 6 months ago. And I definitely personally did as much as I possibly could while buying was good. But this isn't going to be a 2-month, 6-month boom. This is going to be a cycle. And this cycle is probably going to be more of a uniform cycle, which is probably the most interesting thing that I've seen in the property market in my time, is that you typically go to that market's booming or that market's booming. If you look over the last 10 years, you can literally pick out probably 1 or 2 major cities over a 2-year period, which absolutely were breakouts. But going back to that indices report for November this year, every single capital city and every single regional centre has all grown for the month of November. It's the first time since 2002. And this is going to be one of the most amazing things, I think, out of this growth cycle. And I don't think it's going to be a rising tide lifts every ship, but you are going to see better growth over the whole nation than we've probably seen uniformly for a long time.
So let's talk about bust, though. So what needs to go wrong for this all to come off the rails?
Inflation, I think, is going to be the big one, and
then they're going to be controlling that. That's when they'll start ratcheting up rates again to slow that down.
Exactly, and that's where I think, and we just seen we've gone into a recession, straight out of a recession, and we've got all this data now saying that it's probably going to be a pretty radical 2021 as far as economic growth is concerned, and then 2022 didn't look too different. Now, obviously, it has to get back. We're still below where our GDP was at the start of this year anyway, so that's going to take some time. We're still not going to be there immediately. So I do think, though, that within the next 12 to 24 months, that is going to be a very interesting part of this whole equation, is as and when the government starts to think, hang on a second, we're cooking a bit too hot here. We need to think about how do we control it. And typically the first lever is interest rates to then slow consumer spending, slow sentiment, etc. So that is going to be the part which will be the first dynamic. And we've got to keep an eye on that. I mean, we've got other superfluous things that are happening in the background, China trade wars, talking about iron ore, tariffs, etc. Those things will have an impact.
You see they block lobsters, speaking about lobsters?
I thought you said rock lobsters.
No, not rock lobsters.
Well, this is probably a good thing, because there's going to be more supply for you for Christmas. It's not rock spider, you idiot. It's a rock lobster.
Anyway, so Paul, you haven't really given me a lot, to be fair. You've told me Brisbane and Perth. Like,
okay,
mate, I could pick up the paper any day and there'd be someone
quoting me.
No, you reckon?
Yeah.
They'd be quoting me as the most ill-informed person in property.
The worst
in Australia,
podcaster in
Australia.
Australia.
Australia's worst podcaster, Phil Tarrant. The guy that knows nothing. But make me feel happier, and let's round out this podcast.
Yep.
So, as you know, Smart Property Investment, we invest in property.
Yep.
It's been a big part of smartpropertyinvestment.com.au for many years that we share our journey, good and bad.
Yep.
We bought a whole bunch of stuff in Brisbane. Let's talk suburbs.
Yep.
Probably 20, I can't remember exactly, between 2014 and maybe 2017 or something. Right. A block of unit and all this sort of stuff up there. So I'm going to go for a couple of suburbs where I've bought, and I'm going to tell me whether good, bad, or indifferent.
Yeah.
Kalanga.
It's a buy. It's a hold.
Good.
Yep.
Yeah. I bought stuff there for like 230 grand.
Yeah. It's
freestanding houses.
It would have already done well.
Yeah.
I mean, to be fair, places like Kalanga and parts of the Moreton Bay, if you held them for the last 5 years, they've actually grown by 20-25% and they've been cash flow neutral. Yeah. So, I mean, it goes back to what's your justification of what's a good and a bad outcome. If you make 20% on leverage money at 80% LVR and it's cash flow neutral and you've exposed it over and over, is that good or bad?
Yeah, so they've been good, but they haven't been the paradigm of Sydney, right?
Yeah, I'd hate to have a chat with your buyer's agent, how much grief you give him. I actually know who your buyer's agent is. He's a good guy.
Very good buyer's agent.
He's a good, or not as good as me, but look, we have debates about this every week.
Yeah. Mate, you're both as bad as each other. I'm the only person that really flies the flag. That really matters. It's all about me.
It's all about me.
Launton. I bought a block of apartments.
I know
up there,
exactly where it is.
Five of them, right near the train station, and an Aldi and a Chinese restaurant.
Oh,
and a daycare centre.
Oh, excellent. Excellent. No, look, I think from memory, they're separately titled. So, yeah, mate, look, I think that they'll do, the block itself will do better than the properties themselves because there is supply in the attached markets there that's going to consistently come to the market. But the location of the block itself, it'll remain cash flow neutral. I dare say you're probably going to cop a little bit of land tax knowing that they're, and the rates, et cetera, because they're individually titled, you probably got a little bit more holding costs. So the holding costs in that situation is probably a little bit high. However, the land itself will be well positioned. That's going to be a good legacy for your kids.
Okay, good. Thinking here, Springfield.
Yeah, getting better now. I think Springfield is getting better. Ipswich in general is getting better. I think you go through what happened. There was a big land release, and that goes back to where some of those markets saw a lot of additional property come to the market. And that was one of those areas where the detached market saw a lot of development. That's getting better now. We're starting to see a lot more money pumped in there. The actual supply is drying up a little bit.
That's a freestanding house.
Freestanding house. Yeah, and Springfield Lakes and what's happening in the general area there down towards Redbank.
That's the biggest planned area in Australia.
In Australia's history, it's enormous.
Fair bit of
it's huge. There's another decade worth of infill happening there. So that'll continue to bubble along.
Okay, Logan.
Yeah, probably be out of what you just mentioned there. Probably be my least preferred, least preferred market and property type. That would be, and not to say it's going to do horribly.
I think that's Logan Central, actually. The actual Logan Central.
But that property type, especially attached, but in that area, a lot of low cost housing, 70% plus renter ratio to owner occupier ratio. So you don't have a huge amount of additional demand by owner occs in that area. Probably wouldn't be out of those four the one that I'd want to hold long term.
Okay, freestanding house, Kingston.
Similar, but better.
Yeah.
Just due to the fact that
freestanding.
freestanding.
It was like 230.
Yeah. No, and it's the freestanding side of things there is probably going to be what will perform much better in that market over time.
All right, good. Well, you made me feel a little bit positive.
Good.
Yeah.
Mate, I think one thing that'll make you feel positive, if I talk about, not those lower end entry level markets, but what other markets are probably trading at higher prices than they ever have now, and considering your nickname is Kirribilli Phil.
Well,
I don't think it's nickname. I think it's essentially that is the attachment to your name. It's a preamble every time, from what I hear around the traps anyway.
Well, that's not very nice.
Well, why not? It's where you live. You fancy? And you try to make out that you're not, but you are.
Mate, so I can walk to work quickly.
Of course it is. That's what it's
I'm
about.
wed.
Yeah,
I'm wed to the Smart Property Investment Show.
Wed to the waterfront.
Yeah, maybe. Anyway.
But I would attest to that market in particular, and I'm not going to say Kirribilli in particular, but I'm going to say that the markets that we're seeing in Sydney, if I speak specifically to Sydney, and I think this is a market that's going to do really well over the next 12, 24 months, is those upgraders to those premium areas. So people who are sort of trading out of those 1.5, 1.7 mil houses, which obviously are still decent in decent areas, but the change of COVID, the necessary or non-necessary aspect of people to go to a head office in a CBD every single day and worrying too much about that, as opposed to worrying about, I want maybe a larger property with a study, maybe with a nicer yard, a pool, even by a lifestyle area. We're seeing now all those same facets, cheap money, access to credit, all those things in a assured economy. Those upgrader markets from 1.5 to 2 all the way up to I think around about that 4.5 mil, that market is absolutely on fire right now. And I can attest from the tip of the northern beaches down to upper and lower north shores, eastern suburbs down to the southern Shire regions, those areas are absolutely cooking. And I think we're going to see 10% plus in those markets over the next 10 to 12 months again as well. So,
right.
Yeah.
There we go. Well, thanks, Paul. That was quite a detailed discussion.
Good.
Covered a whole bunch of topics and areas, and for some people maybe a bit of a lesson in how the banking system works and how to read the play better so you can get involved, get stuck in. I guess the summarise is get stuck in.
It's time. If you haven't, start. And and when I say start, don't go buy tomorrow, but I think start with a discussion with your broker. And if you haven't, start a discussion with the broker, get your strategy right, get your borrowing capacity set, get your structures correct, and then go and execute.
And just remember, a lot of people did well in property in the last big shift in cycle. I'll talk about Sydney, for example, because they were just there, right? They just bought something and as a result of it have done well through luck or chance or whatever, right? But a lot of people did better than most because they bought the right properties in those markets. So just don't think that by being in the market, you will benefit from it, because you know what? People are going to blow their dough during this period.
Absolutely.
They're going to buy the wrong place at the wrong time for the wrong reason. Don't be that person. Don't be that person.
Absolutely.
You know, if you're going to play in this market, make sure you're doing it the right way. And hopefully Smart Property Investment Show helps you out with that stuff. But people can talk to you if they want. I don't know anything about property. We've made that pretty clear, but you actually help people out, right?
They absolutely can. Look, I guess to that point, we're early December now. I'm actually really just opening up our calendars for later this year, early next. And the reality is that we're getting so slammed with new inquiry in the sense that people are realizing this. The more informed people are saying, I need to set a strategy and let's execute on it, because like you said, it's not going to be a rising tide lifts every ship the same way. And if there was ever a time to buy the correct property, it is more so now than ever, because you're going to do well, and you're going to do really well by buying that correct property with the correct structure that fits your strategy. So Pure Property Investment, they can reach out to us, book in a time with me directly. We've also just released our top 25 guide of properties under 500 grand, markets, suburbs, and all the rationale behind that. So if they jump on purepropertyinvestment.com, you can literally download that.
You actually tell them where you go,
it's literally suburbs. It's properties in suburbs. It's the rationale. It's
I've seen these reports. It normally says you need to buy near a train station.
There is zero buying entity and anything that's specific around the generalization. It is a suburb. It is a postcode. It is a property type in each one of those. And it's the top 25 under 500 grand that we would suggest that people can consider. But again, depending on their situation. And this isn't just going to say it's all in the same market. There are a varied number of markets, but they can download it for free, purepropertyinvestment.com, and they can grab it today.
What's number one? You're not going to tell me. Go and download the report. Go and get the report. All right. I don't know. I'm going to go get the report myself. Anyway, thanks, Paul.
You're welcome.
Remember to check out smartpropertyinvestment.com.au. Over Chrissy, make sure you're tuning into the Smart Property Investment Show. We're going to be doing lots of these chats. Keep engaged. Keep connected. Put it on the background with what you're doing, mowing the lawns or driving somewhere on the family holiday. I'm sure it'd be a great way to keep the kids quiet listening. But look, I do appreciate you tuning in. I get a real kick out of recording these podcasts and just doing my bit to hopefully keep investors better informed and making better informed decisions. And that's what we do. If you're not yet subscribing to Smart Property Investment, you can do so on the website. Just click the subscribe button. Press the subscribe button wherever you listen to this as well. And social media, if that's how you like to get your info, Smart Property HQ, you can track us down there. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Are you in the real estate industry? We're on the lookout for Australia's best agents, networks and property managers to enter the REB Awards 2021 with principal partner List Ready. The awards provide an invaluable opportunity to showcase your contribution to the industry, raise your profile on the national stage and celebrate your achievements with your peers. Nominations close in November. Start your nomination now at realestatebusinessawards.com.au/REB-awards.